Hey, hello folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson. This is our options guide, cracking the code on options. Hopefully you guys can play along here with us. We're going to actually start off with basically simple concepts and build into real life examples in this particular webinar. So with that said, we're ultimately going to find what it is about options that most people are missing and that you actually need to know and have top of mind anytime you're trading options, all right? But before we get on with that, this video is going to be on the long puts, folks. Give me 1 second. All right, the options guide. Before I get on with that, folks, before you go, make sure you guys are subscribing and hit the bell right next to it, because I don't always come in announce. I'm doing daily market commentaries where I'm talking about these markets in turmoil right now. Well, if you have that little bell lit up, you'll know when I pop in, and most likely that's going to be unannounced during those daily market commentaries, all right, which is spotting the trade. Further, make sure you guys give me that thumbs up, hit that like button, smash it, because what it does is it tells this bot to run out and find somebody that looks like you to share this content with. So help us out there. And hey, folks, throughout this video, comment. I'm going to be keeping my eyes over there. If you aren't clear a concept, or you just have, you see me screw up, throw it over there and say, hey, Wolfman, yada, yada, yada. All right. I'll be keeping an eye on it. Try and keep me up on that. All right. Keep me on my toes there. All right. Like I said, this is going to be on the long puts. If you missed last week's, we did that on the long calls, which probably didn't work out too well. Well, we actually talked about some of the stocks that would do well, like some energy stocks and things like that. That said, going forward, long puts look like a good call today. Well, is it, or is it too late? I'd say it's too late to be buying puts right now. As a matter of fact, you're going to be throwing money away, and I'll show you how that is and why so many people on days like today do the absolute wrong thing just out of anxiety. They buy and they don't think twice about price. And I'm going to teach you guys how to avoid those pitfalls today. So we'll make it simple. You know, as beautiful as writing code is, it's all zeros and ones. It's as simple as it can get. And literally options can be broken down very similarly. As long as you understand what the O's and the ones are, then you are ahead of the game. And that's what I'm going to try and get you guys on top of here in this video. So one thing we've seen going on right now is, has anybody bought a house recently in the last, let's just even say 1 year? If you bought a house at the beginning of last year, or maybe during the pandemic, you've seen your house do very well. As a matter of fact, those prices are increasing dramatically. So why is that houses are going higher? Well, we'll talk about that a little bit. It has to do with supply and demand, right? Yeah, that creates higher prices when there's lack of supply and a huge demand, which we have seen. But we are also attributing that to the volatility created by coronavirus, right? Folks are trying to get out of the cities and into the suburbs. That's driving housing prices in a lot of rural areas. Another thing with this, the housing prices going up, if you bought a house at the beginning of the pandemic, right? Did you know you were buying low? We could have had a housing crisis. We could still have a housing crisis for people that are trying to lock in low rates right now. They're paying through the roof. It seems like for houses, are they buying it at the high, or are they still buying it at a low? Well, we don't really know a lot of times if we are in fact buying low and selling high, right? Like here, for instance, if you were, let's say we did a buy right here, you buy low. Well, is that really low? Well, this could be considered low, but it came off of that high. So you're feeling pretty good about a correction. Hey, it's time to buy. So you buy. Well, then in fact, if you sold at that mark, you bought low, sold high. Pretty simple. What a novel idea. The problem is how do I know when it's low, right? Like we got a bit of a pullback, but it could have continued to sell off, right? We just never really know if we've gotten that low, because here you could have missed out on that big rally to the top and thought, hey, you know what? I wanted to buy it here and I didn't. And then you see the market shoot higher. Now you were just like kicking yourself because you missed out on that opportunity. But lo and behold, you got a correction, right? Now you're thinking, all right, I've got that correction. It's back to that level I originally wanted to trade at. That's my money, right? So you get the correction, you're super happy, but boom, market free falls down. Now you're losing money. You still thought you bought low, but you didn't. So you can never really know if you bought low or even sell high. Maybe you saw it come down there twice and thought, oh my gosh, it's banged down that bottom low twice and I'm still in this. You get a little bit of a bounce and it starts correcting. What do you think? Well, time to sell out, but you never really know. I don't know what happened there. I closed my, hold on a second, folks. As a matter of fact, while we're doing this, where's Waldo, folks? If you guys want to try and find me, who can find me in that picture? I'm in there. Anyway, I'll give you the hint. It's right here. As a matter of fact, if you look around this entire pit, there's two people with headsets on. This guy, George Arvanitis, was a clerk of mine, and me and my partner here. There was the three of us. We were the first ones in this arena to bring headsets to the floor. Innovation. There we go. All right, so let's go from the current slide here. So we never really know if we are buying low or selling high. This could have been a high, but lo and behold, we got that rebound. So the bottom line here is if you, and a lot of you folks probably know charts better than me, and you guys could be looking at the triple bottoms down here and thinking, oh my gosh, Wolfman, why wouldn't you buy there? Well, at the end of the day, we don't know if it's going to be a triple bottom or anything else, but I know a lot of you folks probably are better chartists than me, and you could say, well, look, hey, we're having, had a high, a lower high, and another lower high. Well, that would be a downtrend if anybody was charting it, for sure. Would never really see that breakout. So, you know, at the end of the day, this person could have been very confident they were selling the high, but we just never know. When we're dealing with assets of any given nature, we just don't ever really know if we are actually, in fact, buying that really historical low or the high. And, Sal's asking, what pit was I in? I started out, that was the 30-day Fed funds. I actually started out in the 10-year options, moved 10 and 5-year options, moved over to the 30-day Fed funds. And then from there, I started that group. We expanded into 30-day options, the 30, E-mini S&Ps, the euros, and finally in the grains, corn and bean pits. So we had a pretty big operation, over 50 people crushing it. All right, so this is what I wanted to move to. Options give us a tell. That's the only thing in really financials where you can actually look at something and tell whether it's expensive or cheap, right? If I'm talking about this pen or this pen, you don't know if this pen's more expensive than this pen or vice versa, or this pen, right? Those all will have different values based on supply and demand, for one, right? These glasses, you know, you could get a pair of cheap glasses or this pair of cheap glasses. And we don't really know if we're buying lower and selling high. You could go all the way down to the price of corn or wheat or PVC for that matter. But options will give us a tell as to when prices are cheap in the options, okay? We won't know by looking at the options pricing specifically. You know, this option is $2.50 at $2.75. I cannot tell if that's expensive or cheap just by looking at that. What I have to do is look to see what volatility is doing. And volatility looks like this. And folks, don't get confused here. Please don't get confused with When I'm talking volatility, I'm not talking about the VIX, okay? I'm talking about implied volatility, all right? And implied volatility is a gauge of volatility for a specific underlying. So every underlying has its own implied volatility, all right? Tesla's implied volatility might be 1.3, whereas something like maybe Disney is down in the 0.3 range, okay? So very, polar opposites in terms of volatility. So when I'm looking at Tesla, I have to look at Tesla's volatility. When I'm looking at Apple, I have to look at Apple's volatility. I do not look at Apple's volatility in relation to Tesla. That doesn't make sense. I'm comparing apples to oranges. We don't do that. We need to compare apples to apples, and I have to look at whatever stock I am and say, right now, volatility is at this point, and it's been all over the board before that. Therefore, I got a pretty good gauge as to what pricing is, right? For instance, if I'm looking at this volatility quote or chart, I can see that this area is an area where it is a low. This is actually a pretty low area for volatility if I was looking at it. And then I would say that something like this is a relatively high mark for volatility, all right? Meaning that when volatility is up here, they're expensive. Let's just say it's like $3 sign or $5 signs. That's expensive up there, and down here, it's super cheap, all right? Because as volatility increases, implied volatility, as it increases, our prices in the options montage increase. As volatility goes down, our prices go down in the option montage, all right? Has nothing to do with what the underlying is doing, all right? The underlying could be completely stagnant, and volatility starts rising from one day to the next. We see volatility start to rise and that underlying price doesn't move whatsoever. We would see the prices of all of the options increase in value due to the increase and decreasing of volatility coefficients. All right, really important. This is the most important Greek in your option montage, which is where you see all those Greeks. As a matter of fact, implied volatility is Vega in the options montage. All right, implied volatility is just Vega volatility. So as Vega increases and decreases, we see those prices increase and decrease. This is an exact example of volatility for a specific underlying. It doesn't matter what the underlying is. We're going to call it XYZ. We don't care what it is right now. All I want to do is say, what is XYZ's implied volatility telling me? We can see this is an implied volatility quote. Now, some folks were asking me after last week's video, can you use historical volatility because I don't have the implied volatility chart? Yes, you can. I like implied volatility because it's forward looking. Historic volatility tells us what's happened, but having known what's happened in the past and where we currently are with implied volatility, we can use that as a gauge because it has a tendency. Every once in a while, it'll break out like this. We can see it break out. That could have just been an absolute, out of left field kind of thing. So you'll see that happen. As a matter of fact, I got an example coming up. But what you're trying to do is say where we are right now, which is 28, in relation to this high, basically going way back. I'm discounting a bit of that high. And just like when I'm charting, I'm trying to hit about as many of the bottoms as I can. So you can see down here, we would say, let's say around 18 is our low, and up here around 37, I'm going to call it as a high. Right now, we're at 28. So really, actually, let's just say it's 38 just for math. Oops, my finger touched something there. I thought I had that thing turned off. One more, right? So let's say if it was 38. Why is that doing that? Don't do that to me. All right, 38. Let me get a different pen. I think it's my pen that's making me do that. So 38 18, and 28, let's call it. So really, right now, volatility is just slightly above the 50% mark, right? You can kind of tell that because it really 28, 29. We can tell that this is slightly elevated. So what I say when it gets above 50%, that this is a sell zone for option and this is a buy zone for options. Really, for newer traders, you want to try and get as low to the bottom before you start buying options and as close to the top when you're selling options, all right? What this tells us is no matter what XYZ's price is from day to day, that this type of move, even if the price of the underlying didn't change, we would see the options increase in value. So what was going on the last couple of days? This is a really long dated chart for deer, all right? And the reason why I wanted to show you this is because volatility has a tendency to stay in a tight range for an underlying for a very, very long time. We can get that these underlyings like to stay within this range. Yeah, during the pandemic, we got that massive spike, a black swan event, if you will. I like to say that, you know, I'm going to discount that move because we probably won't see anything like that for another 10, 15 years. And I'm not going to live my life based on that black swan event, all right? But what I wanted to show you here is I got a pretty good gauge. You know, it's not the prettiest in hitting all of the bottoms, but I got most of them as I could. But you can see that even way back here in 2000, I think 18-ish, we can see that the volatility had a tendency to be at a high around 45 here for deer, right? And then we could see that those lows were somewhere in the 20s. Where are we right now? If we go to this again, it's near that 20 and near that 45. Yes, we did get that massive spike out, but for the most part, we could zoom in on this and see that volatility is in fact actually high for this underlying. Yes, there is this spike here. I'm going to discount that, but because all the way back pre-pandemic, 2018, we could see that these coefficients were pretty in line. Yeah, it's a little bit slightly elevated now, but compared to back then, it had a bit of a wider range. But at the end of the day, we could see that if anybody was looking at this chart and thinking, I need to buy puts to protect myself, to the downside, is paying through the nose for those premiums. Why? Because we can see volatility is at the highest levels we've seen in a very long time. Yes, there was this spike. Actually, this spike did correlate with the pandemic, but I actually think this spike is where news was released that Deere bought this company. It's called Site One, which is really into pools and stuff like that. They're basically a big supplier of pool equipment, PVC, all of that stuff. So when they bought that company, it went through the roof because now they're selling smalls like they're going out of style. And those prices, because of gasoline prices going up, those prices for those byproducts are going up as well. So those guys are getting their margins intact. So if we tried to take advantage of this sell-off here, we can see that volatility was in fact really high during that time, and people were buying premiums at an elevated level. That's not what we want to do. We do not want to buy that premium way up there. And even if we were directionally right, if that volatility comes out, it's going to offset all of our gains. So you have to make sure that when you're setting these strategies up, you know what the levers and pulleys are doing to the prices that you're trading, right? It's not like I believe the underlying is going to go through the roof, so I just go buy calls. Well, that might be what a lot of people teach you, but in an environment that we are in like today with this bounce back, there were probably people out there buying calls left and right, open fist. Volatility going up, VIX going up into the 30s, that does in fact push these higher for all of the underlyings. Don't get me wrong. You can look at it as a broader gauge, but what I'm saying is when VIX is at 30, it doesn't mean that volatility for this underlying I'm looking at is actually high. So it's just a broader gauge. But what we could see with this if I were in fact wanting to play this trade out to the downside, that volatility is so high that I would get crushed. All right, if this volatility comes out, could offset entirely all of my gains. So at the end of the day, make sure you are confident and understanding what Vega, implied volatility, or volatility for this underlying is doing. Now, like I said, you can use historical volatility. I have no problem with that when you're trying to determine whether or not the prices are expensive or cheap. Historical volatility will work. I like to use implied volatility. So what have I said all day? Volatility is driving those prices, right? Think about it right now. What's going on? Think about even your house example, right? Volatility, people coming out and trying to buy without really thinking twice is driving prices higher because of that volatility. Same thing happened in the housing crisis when we saw the prices go down. People were selling houses, unloading houses like they were going out of style, all right? So volatility does in fact drive prices, whether it is gold, wheat. We saw wheat go through the roof today, last couple of days because of the crisis with Russia, right? That's making prices go through the roof, all right? That is all being driven right now by volatility. So when we're looking at this example, let's say I have a bearish assumption with Snap, all right? So I want to play Snap to the downside. Nice bounce today. Looks like we fell short of the 50-day simple moving average. So we have failed that simple moving average several times, creating lower lows, lower highs. I'm going to look to see this to play back down and retest this $25 handle. I'm looking for a $25 trade, or sorry, yes, for it to roll back over somewhere to the 30, maybe even test that 25 handle. That's what I'm looking for in this move. So I've got my directional assumption. Does that mean I immediately go out and buy puts? Well, we have to look at volatility. Well, we can see volatility's low here for this underlying isn't the same as what the last example is, right? Snap has a different range, right? Its range goes from about 120, let's just say, 1.2 or 120. And right now we're at 73, and we can see the low here is, let's just call it 50, right? So in this case, we could see that the 50% mark should be somewhere closer to 85. I'm just doing the math in my head. So somewhere around here is 85. That's basically equal to the 50% mark, right? So I say this is a sell zone and this is a buy zone. And we are in, anybody got the answer? We above or below that 50% mark? Just slightly below. So with volatility, the way it's been going and driving higher, I'm expecting this one to get a little bit of a move to the upside as well, because I know that those prices have got to be cheap based on relatively cheap. I'm not saying super cheap, but I'm saying cheap enough to where I'd rather buy them than sell them. All right. So making it simple, right? We've talked about simple concepts, how volatility moves in different aspects of our lives. Now let's look to see what it does in the option montage. Now, remember, I said that Vega is implied volatility. So when we're in the option montage, that's this page. Here's your calls. Here's your puts. This is Vega. Just implied volatility. It's a fancy name. It's not even a Greek. Implied volatility. All right. So let's do a little bit of a review here. Talk about these Greeks. Don't run away. But Vega, what I was talking about, if volatility increases by 1 percentage point, that's a 1 percentage point. Okay. Not a very good one. actually looking more like a 2 almost. All right, so 1 percentage point increase in volatility. That means this goes from 79.95 to 80.95. Right? So we've increased 1 percentage point. This volatility coefficient goes into those premiums, even if this underlying stays the same, doesn't trade a penny in either direction. We will see 2 cents go into that premium correlated to that coefficient. Again, here, 4 cents would go in. What are you starting to notice here? 6 cents starts to go in there. Go out a little further. 7 cents goes into there on 1 percentage point increase. If volatility for this underlying increases by 1 percentage point, all of the options on both sides go higher by that corresponding coefficient, right? And what else are you noticing? The further out in time we go, volatility is more impactful, right? So if I want volatility to impact my trading, I'm probably going to lean towards longer duration, all right? What will nail that into for sure? I want longer duration. Theta. Theta is that thief in the night that comes and steals your premiums, all right? Theta is the thief. Why do we call him the thief? Because he's always stealing your money. Look at this. If I look at the thief on the theta and notice it's always negative, well, if one day goes by, 11 cents comes out of my premiums in these really close to expiration. 11 cents comes out of those. Just one day, right? Let's look and see what happens way out here in time. Theta is less impactful further out in time, right? So if we find that implied volatility or Vega is really low for this underlying, we know we're leaning towards buying. Well, if we're leaning towards buying, we have to be good stewards of our capital, which means that we need to limit that thief in the night that comes and steals your premium, all right? And that means going out further in time. Yes, people will say, look at those premiums, Wolfman. You're telling me that they're a lot cheaper. Well, they are more expensive further out in time than what you're looking at in the near duration, but keep in mind, you're paying for more time to be right, okay? I'm paying $2 more to get another 60 extra days, okay? Something else I want you to notice before I flip through this, I think I'm getting a little bit ahead of my slides here, but it is what it is. I want to limit the theta decay. I want to go further out in time, take advantage. So when we're buying, yeah, you are paying more. But one thing to note, that if I buy out here, in the buy zone for me is you want to be more than 70 days. If you're buying more than 70 days, less than 35, or I'm going to say 45 days is really my sweet spot for 40. Inside of 45 days is your sell zone, right? So a little quick hack there for you. If you have high premiums or high volatility and you're leaning towards selling, then you want to go to the near duration. Inside of 45 days to expiration, we're right at 49. That's kind of a gray area right there. You've almost got too much time or not enough time left in those. But I'm getting a little ahead of myself there. What I want you to notice here, though, is how theta starts increasing. If I get involved in this 85 days to expiration, look what happens the next almost 40 days. Theta only increases by 1 penny. But had I got involved in here, well, if I've gotten here the next, 27 days, almost 30 days, you can see volatility did increase by 2 pennies now. But now if we go from 22 days to 8 days, look how much it almost doubles there. So if you are buying with like less than 35 days to expiration, folks, you're making a colossal mistake because you're just feeding the kitty or theta, all right? You're just giving him all kinds of money. You have to immediately be right when you buy options inside of 35 days to expiration. Theta is not consistent. It ramps up as time goes by, all right? And it will continuously snowball and get bigger, all right? Until it basically takes all the money left. So in that case, I want to lean towards further duration, and I prefer to go for around somewhere in the mid 30 delta, all right? So we've talked about theta, we've talked about vega. Yes, I'm going to talk about delta here for a second. But most people will tell you delta tells you how much my premiums are going to be affected by $1 move, all right? And it's expected that the dollar is moved higher, all right? So delta tells us what happens when $1 higher happens, all right? 50 cents goes into the premium there. 37 cents goes into the premium I'm looking at, all right? Or comes out on the puts. You notice that the calls are positive because the assumption is higher. If we move $1 higher, calls increase by the delta. Because the puts are a negative delta, think about if you buy a put and it's got a negative delta, that's because the assumption is higher. It's going to make your premiums go down. But if the underlying goes down, a negative plus a negative makes it a positive to your position. So everybody pretty much knows that. We on the floor used to say delta is data. Because really, delta tells us probabilities, and traders would rather talk in probabilities, all right? As a matter of fact, if you asked a trader, who's going to win the basketball game tonight, the Wizards or the Lakers, well, they'd say, I think the Wizards have about an 80 delta, which means an 80% chance of winning. Don't quote me on that betting. Everybody's like, sold. But anyway, so that tells us that these puts have a 37% probability of being in the money by 1 penny at expiration, meaning in 85 days, I have a 37% probability of snap trading being 1 penny in the money, so it'd be $36.99. All right, so this is a 37% chance of that happening. A settlement of $36.99 or lower. There's only a 37% chance of that happening. All right, but delta is data, and on the floor we have a floor trader hack, and we would say that delta times 2 equals your chance of touch, or percent of touch, probability of touch. So 2 times the delta, meaning 2 times that 37, basically is telling me I've got a 74% chance of $37 trading of just that price. Timestamp. The timestamp of $37, meaning it's traded officially, that price. So there's 2 times the probability of being in the money is the probability of touch, meaning the underlying will go down, trade 37, maybe just for 1 lot, and then all of a sudden it goes back up, okay? There's a 74% chance of that happening. 37's just trading. There is only a 37% chance of it settling $36.99 or lower, okay? So in this case, I'm going to play the probabilities out. If I start seeing this go into the money, I'm going to have an itchy trigger finger because I know I've beaten the probabilities, right? I'd rather take a 70% win rate than a 37% win rate. Meaning when the underlying moves and hits that price, that's when I want to get out. Something else I mentioned. A lot of folks will talk to you about trying to buy in the money puts at around the 85 delta or 75 delta or whatever it is in the money. And they're going to tell you the reason why you want to do that is because those in the money options will retain that value. Well, that's yes and no. Yes, it will retain the intrinsic value. It's still going to lose as much extrinsic value as the out of the monies, meaning theta decay affects both of the in the monies and the out of the monies equally. All right. But the in the monies have to at least include the benefit of owning the option, meaning that this $41 put has to at least be equivalent to be between $41 and between, I'm just going to call it $39. So there has to at least be $2 of real value, right? Because from 41 minus 2, that gives me 39. That's where right where we're trading, 39, right? So there has to be at least $2 of intrinsic value. And what's the balance of that $4 and, let's call it 40 cents? That's theta. Look at that. It's the same thing we're looking at my strikes, right? So if I am directionally wrong with my trade, right? Meaning if the market goes higher after I've entered this strategy, so I buy these 37s. Let's say if I'm the guy that buys these, I buy a put at the 37. I'm risking that $4, right? If the market goes higher, I lose all $4. Well, what if the market goes higher on this one that was in the money that they all talk about? Well, then you lose the $6.35. Yes, you will. When the underlying moves $1, it's going to affect your premiums a little bit more. But at the end of the day, if you're talking about percentage terms, this one will double almost by the time that this one increases by 50%. Because of the nature of it being out of the money, I'm paying less. And as it goes into the money, then it starts gaining a value much quicker. So out of the money options is a much better risk reward. There's guys out there that will tell you you're buying an in the money option. It's an 85 delta. That means you have an 85% chance of being in the money at expiration. Yeah, but only by 1 penny, meaning I would lose everything, right? If I bought this one and it only finished 1 penny in the money, what is this value at the end of the day at expiration? By $41, and it finishes a penny in the money. It's going to be worth 1 penny. I'm going to have lost all of that. Okay, so yeah, it has a much higher probability of being in the money, but it's only probability of being in the money by 1 penny. Okay, it's not that it's not going to move. So these folks that are telling you guys to buy those in the money options, tell them that, hey, why don't you reach out to the Wolfman and do an interview as to why you think your strategy is better. So in this case, another thing, never go buy the offer. Always go to the bid and try and ratchet it up a little bit. So that's why I'm trying to show that in there. Hit in between and work your trade. Because listen, folks, it costs you nothing to put in an order and cancel it. It costs you money if you paid the offer and it's actually, you could have gotten it better. That actually cost you money, meaning you left money on the table. And this is our risk parameters. If the underlying goes higher, I'm going to lose all $4.30. And another thing for some of you newer folks out there that might be newer to trading options, keep in mind, one option contract is equivalent to 100 of the underlying. So just like when you go out and buy 100 S&P, the only real way to hedge that is with a one lot in the option. So it used to be that you couldn't really do anything but buy 100 lots in options, or 100 lots in, stocks. Now you can buy partial shares. So, but you can't necessarily, you can't hedge a partial share with options. So one option contract will hedge 100 of the underlying, or it's equivalent to 100 of the underlying. So with that said, that means if I were to buy this option, I would actually pay $430 because of the option contract multiplier. There's 100 underlyings within this product. Does that make sense? It's kind of like an ETF. Think about it as an ETF. This one, this 37 put in Snap, this one lot, has 100 Snap stock inside of it. Okay, does that help? But if the underlying goes down, I make money. Note that my break even is the price paid minus that $7. So I have to get all the way down to at least right around, what is it, 32.70 for my break even. Now that is at expiration again, when all of the theta has gone away. I need to make up that distance so that my put has intrinsic value of $4.30, right? So I have to make that up. If my out of the money option goes down, I need it to make up at least that distance by expiration. Now, if in the next day or two, we start seeing a move to the downside or even just volatility spiking, I'm going to see this premium go up in value and I'm going to be making money already. Okay. So when you're looking at the analyze tab and you see, oh my God, I got to go down almost $5 in order to get just a break even. Well, yes and no. That means in 85 days, I need to at least, if I haven't covered this trade, be trading at around 32.70. Okay. But in the next week or two, if I start getting a move or volatility spiking right away, then I'm going to see profitability relatively quickly from that type of move. So that's how I'm playing this. I get a move to the downside. Directionality is going to help me through that delta. All right. Delta is going to add in if I go down in value. Also, when we see what happens lately, when we saw these sell-offs, volatility will spike if we see a sell-off. We can actually see volatility spike like today when people were buying calls. So when people are buying options and not thinking anything about price, that's when we see these prices like blow through the roof. So that said, volatility increasing or my directionality moving in my direction, I can make money with this trade. I can also make money. It is possible to make money even in a bullish market with some long puts here, but I have to have that volatility increase at a faster pace than my underlying's increasing in value, okay? I need volatility to increase fast enough to offset the delta that is hurting me on a bullish move with my long puts. Does that make sense for everybody? Don't forget to hit that smash that like button for me, folks. It really does help out. If you had a light bulb moment, please smash that like button because it sends a bot out there to share this content with. Also comment. I'm keeping my eye over there for you folks. Look for the comments. All right. That's about it there then. So with that said, what was I talking about? If I can just basically get a move to break below this Fibonacci, that's basically where we were today, just an about face. I think that this 50-day is going to act as resistance there. Plus we've gotten, look, lower highs, lower lows consistently. So I would expect us to get another little blip down to test that $25 mark. We did hit it on this little drop there. And it snapped back the next day. No pun intended. But I do look for this to come back down and retrade to 25. If I can get it to break below this Fibonacci, I'll be very happy. Retest and move away. I'll probably pull the ripcord because the trade just isn't working out quick enough. Anybody else have any questions real quick? So real quick review on this. Volatility is the linchpin or is the key to cracking the code, folks. You have to know where volatility is on this underlying in relation to the highs and the lows to determine the pricing over in that option montage there. All right. As this number increases and decreases, the prices are going to increase and decrease in value. And it can be dramatic because volatility doesn't just move in one tick increments. Sometimes it moves in 10 and 20 tick increments, which if this one moved in a 10-point increment, right? 10 percentage point increases going from 76 to 86. My premiums, that's 10 percentage points, that's 70 cents. That means if this volatility increases by 10 percentage points, that means 70 cents goes into the premiums. All right. Now, delta here is telling me it's 37. So that means this underlying, if I got volatility to increase by 10 percentage points, this underlying, what if it goes up by $2? Goes up by $2. 2 times the delta gives us right around, it's going to be about 75, 76 cents. So even though the underlying moved higher in this example, we get the underlying move higher by $2, that equals, it's going to actually be 37 plus 40, so 77 cents increase. Because on the second dollar, first, this is dollar number 1. That's that first dollar. This is dollar number 2. So gamma goes with delta in dollar number 2. So the first dollar, I gained 37 cents. The next dollar, I gained 40 cents, which is equivalent to that 77. So a $2 increase in the underlying and a 10% increase in volatility, I would be basically looking at a scratch, right? Vice versa, if it sold off by $2 and volatility increased by 10 percentage points, that would be a home run, folks. I'd be taking that to the bank. I'd be selling out. All right. All right, well, if nobody's got any other questions, I'll give you guys this offer for today. This is going to be, because we're starting this course out as a fresh course, I'm adding folks to this course here so you guys can take advantage of that. The link is right there. If you guys want to pause, punch that into your URL, you're more than welcome to do that. But if you're watching this video, or you can see the comment section over there, I am going to hopefully do this sometime today. There we go. I'll throw it over this link over here for you so you guys can take advantage of it. We're only letting in 100 folks. That's because it gets a little overwhelming for me answering everybody's questions, which I love to do. So don't stop if you guys are part of the class. I'm not banging on you. What I'm saying is, hey, folks, it's a lot going on there. So take advantage of it. We have a lot of great group discussions and things like that. Plus, if you have a question, comment, or anything else, you can reach out directly to me through this offer. And it's only $97 a month. You guys can take advantage of that. All unlimited information coming at you. And that's about it, folks. Other than I want to say thank you guys all for participating in this video. And, you know, there's a link there as well. If you have any questions, comments, or anything else you want me to cover in some of the daily market commentaries, which is Spot the Trade, these videos here, reach out to us at 310-598-6677 or trading@protraderstrategies.com. That's about it. I'll go back to this course. There's rising interest rates in there where you can hedge that. Well, that might be put on the back docket for a little bit, but I mean, that means you can get ahead of that game. You know, interest rates are going to go higher. They're not likely going to go much lower. So not a whole lot of risk to that spectrum of trading. I show you how to lower that cost basis, how to trade around the market profile, which is that blue stuff that I had over there on the side for you folks. And that's about it. Without any other questions, I'm going to let you guys go. I do appreciate you. Before you go, smash that like button for me. I know there's a lot of you guys out there that haven't yet, so please hit that and comment, hit the bell next to the subscribe button so that you get notification when I'm popping in on Spot the Trades. That's not really a quota. We have to announce when we're going to do it, but it's not really announced because I just pop in when I see something or want to talk. All right. So if you want to chat with me in the mornings, hit me up. And if you can't take that, take it easy.